Welcome to the Trader's Desk. It's the 9th of March, and we're going to see quite a few interesting things that have been happening in the market. And then we'll also figure out what to do next and how to navigate this very tricky market. So on the agenda today, we'll take a look at the macro backdrop and try to make sense of what's been going on, and also, most importantly, what lies ahead. We'll do a little bit of our usual price action analysis across sectors, industries, factors, just to make sense of what capital likes and what capital doesn't really like in this market environment. I've got quite a chunky bit on long and short trades. We'll look at one company quite a bit in detail, or rather one theme that can be expressed across many different companies within the financial space. And then finally, if we've got some time, we'll do some Q&A. Before we get started, this is not financial advice. This is purely for educational basis. Do read the disclaimer. And all the material presented here is copyrighted and owned by the Financial Traders Hub. So some notable charts. The equal weighted version of the S&P 500 looks like it's bounced off the 200-day moving average. So a lot of the major broader indices like SPY, QQQ, and so on have shown similar technical behaviors. So they all sold off to the 200-day moving average. And now on Friday, they rallied a little bit as they bounced off that line. So the moment of truth is really now waiting to see whether they retest these lows and then break below, or whether we get a bit of a rally from here. And then we'll see whether that's just like a fake relief rally or bear rally, as we call it, or whether that's the providing a bit more credence to the bull market, and that could lead us higher from where we are. So it's really a time of flux. So we all have to pay attention to what's going on in the market and take it day by day. We'll also get data that's coming out, and we have to review our bias or our views on the market accordingly. And then we've got the Magnificent Seven. So this would be a chart that's not unfamiliar to you. We've been following this before, well before the breakdown. I think 4 weeks ago, when this was trading at 55 or something, we were looking at this chart, and now this has broken down meaningfully lower. We're trading at around 48.86. So once again, it looks like on Friday, we've gotten a little bit of a bounce. So the reason we look at this chart is because the Magnificent Seven have been the companies that have led the S&P 500 and the broader market higher. So by definition, that means that a lot of funds have been overly concentrated in these stocks, right? So if you look at the RSP and you compare it versus the SPY, this is an exercise you can do in your own time. You'll see that the SPY has rallied far more than the RSP. And the difference there is because the Magnificent Seven have a greater weighting in the S&P 500. So with the Magnificent Seven having led the market higher, would it also make sense that if this starts breaking down, that the whole market just crumbles through with it? We're still yet to see, but we've already seen 3 weeks of turmoil. Volatility has crept up, and it's high, but not as high as things have ever gotten in the financial markets. But it's high enough to scare a lot of people, especially funds which are over leveraged. So there are many hedge funds, there are many institutional funds that have been complacent and just been buying the Magnificent Seven and not doing real fundamental work on these, also using a lot of leverage. When volatility creeps up, these funds have to deleverage, and that means only one thing: they have to sell a lot of their holdings. So the sell-off that you've seen so far is, from my perspective, a combination of a growth slowdown being priced in, and at the same time, as everyone is rushing for the exit, that's driving the prices further lower. So it's a little bit of a of a self-fulfilling prophecy where more selling begets more selling, and that drives the share prices much lower. So as everyone realizes that they are over leveraged and they all try to deleverage by selling at the same time, then we see the price action being quite brutal in many of these major indices. So you also need to understand that these funds don't just own the Magnificent Seven. They could probably have 50, 60, 80, 100 different holdings. And as they are deleveraging, the portfolio managers are just going through the whole list, screening it, and then deciding which of these other companies shouldn't be on their portfolio based on the new environment that they foresee themselves to get into. So if we are going into a growth slowdown environment, as an example, do you really want to be holding cyclicals that are have a little bit of debt and haven't really got a lot of growth ahead of them? Absolutely not. So there's a little bit of indiscriminate selling that happens in this whole process, and that's what's driving the volatility higher and also providing a lot of fuel for this whole sell-off. I hope this helps to make sense. If you want, please feel free to unmute and ask any questions on this topic. This is a very critical part of understanding price action positioning in the market that any trader needs to really know, in the greatest detail and depth. Okay, so if you have any questions, feel free to ask it now, because later on we won't have much time to discuss these. Okay, I take it we don't have any questions here. The other chart I also wanted to look at was the momentum stocks. So there's an ETF called MTUM. We saw it last week, and within a week we've had a massive drop in this ETF. So what could you have done last week? You could have just looked at this ETF, looked at the holdings, and picked a few companies that you think have very poor fundamentals, and then just short them. You'd have made a fortune. Of course, I cannot tell you exactly like every single step that you need to take after you look at these graphs or anything that I have in my presentations. These are highly actionable. There are thousands of charts I could have picked, but I picked this one last week. And you always need to take cues from whenever I'm presenting something. It's not just to fill presentation slides. There are very good reasons behind having these slides in to trigger some thought. And of course, I will never do the work for you. I will give you snippets, and then you have to take it, think about it, and then do your own work, and then earn your money, right? If I was just presenting a bunch of tickers and asking you to go long, go short, that would just be a total disservice, because then you're becoming reliant on someone and you're never going to be independent in the financial markets. So I'm hopefully trying to spark some thoughts and trigger you or push you towards doing something with all this information, and also showing you how much you're missing out by just not actioning on a lot of these ideas. So the momentum factor ETF, it went down from, let's say, 220 to 204. That's easily like a good 10% move in the index itself. The stocks within would just have gone down 30, 20, 30, 40% easily. And it's not very difficult to identify the stocks with poor fundamentals. We've gone over this so many times, right? You'd find fundamentals similar to C3.ai and all these loss-making companies. So that's a bit of advice from my end, guys. Take action. Nothing happens without action. Be curious, be intellectually curious, and always dig within these snippets of information that I'm presenting to you. There's a lot of value you can create for yourself. It's literally not about the money you make in the next week, month, or whatever. It's literally expanding your brain and being able to think through these things on your own independently, and then be able to source trade ideas in any type of market environment and do well for the foreseeable future. That's the real value of what we're trying to impart here. If it was just a case of giving a bunch of tickers, trading signals, and all, uh, you know, there's no value in that, right? And anyway, you always want to earn the money that you make. So that's a little bit of advice from my end. We've also seen the crude oil index or crude oil price go lower. So it momentarily broke the multi-year trend line, and that in itself is a it's a big change in how the oil markets are trading. On Friday, it managed to creep back, and it's still kind of sticking to that support line. As you can see, this is a support line that's held up for a long, long time. It's bounced off it many, many times. Now, the question is, are we going to see this break further lower or not? And if we do, I think we're going a bit lower from here, probably in the low 60s or even 55 to 60, which is a big change because, that's not what's priced into many stocks in the market at the moment. Just a little bit on oil. So this week, Saudi Arabia, which is probably the second biggest or largest oil producers in the world, they announced that they will cut down the price of oil by, I forget the range, but it was something like by $0 to $4 5 per barrel. So I think that's a sign that demand is probably reducing. We've seen that the biggest or the marginal drivers of demand have been China and India in the past few years. And as their economies are also slowing down, I think that marginal demand that causes this incremental increase in demand is being revised down. And with that, the volume of oil that's going to be required in the future is probably going to be slightly lower. With commodities, you don't need a big fall in demand by like 10-15% for prices to correct. 1-3% is enough to get a big move in price. So countries like Saudi Arabia still predominantly rely on oil revenue for, all their projects that they're doing. And therefore, at the moment, what they are doing is they are sacrificing margin and, trying to keep market share, sacrifice margin, and try to, still get some revenue from that perspective. So this is a very interesting situation because Trump will also be flying to Saudi Arabia soon. I'm sure he's going to get into a lot of discussions around resolving conflicts. That's first and foremost. And secondly, he's indicated that he wants Saudi Arabia to pump more oil. So that discussion will be something we need to be mindful of and keep track of because it will have meaningful implications for the oil sector. As always, we want to keep an eye on the US 10-year yield. So this has come down quite a bit this week, and then on Friday we've seen a little bit of an uptick. So this week we made new lows in the US 10-year yield, almost like confirming the downtrend in the long-term rates. But then Friday was kind of kind of a counter trend. So we have to see whether we're going to see a bounce from here or whether people will keep buying bonds and then rotate from equities into bonds. I think that's what's happening. And that's not a positive situation for risk assets in general. And then finally, I think this is probably the star chart of 2025. I still don't see it at all in financial media. And this is probably what's actually driving a lot of activity that we're seeing. So this is the USD versus the Japanese yen. Uh, we've made a new low this week. So this is the first time we started looking at this, we were probably trading at 156. Now it's 148 and headed even lower. So you all know the drill here, right? As this goes lower, the carry trade unwind becomes more likely, and it causes a lot more pain to whoever is holding or whoever has borrowed in Japanese yen and invested in the tech stocks in USD. So keep watching this. I think this is probably going to become a lot more important, and it's going to get a lot more attention in the financial media. Quite surprisingly, no one's talking about it. I don't know what people are focusing on. Probably focused on a lot of the Trump show that's going on, and missing, what's happening in reality. Okay, so these are two additional charts that you would not have seen before. The one on the left is the investment grade corporate bond ETF. So this is basically, let's call it the average bond price of corporate bonds in the US. As you can see, and this is across the investment grade corporate bonds. So these are bonds that are, I think it's B and above in terms of credit rating. We have to check this. I don't know exactly from what rating onwards to get into this. But in other words, these are high quality corporate bonds, right? And you can see that, the market is not necessarily that thrilled at the moment about these bonds. As you know, with the prospect of inflation, it's not a great place to be for bond holders. At the same time, these are holders of corporate bonds. So these bonds have a lot of exposure to cyclicality in the economy. And I think we are starting to see a bit of weakness here. And it's probable that people are going to be a little bit more concerned here about credit risk, delinquency risk, default risk, liquidity risks, and so on, which always happens whenever we have a little bit of tension in the financial markets. So that's something to keep an eye on, because if this sells off, then this is going to be negative for risk assets, especially for equities. We have another. I don't think I have it as a chart, but we'll look at it as we do the price action analysis. The credit risk that is being priced in by the market now is on the rise. So this is something that we need to keep an eye on. It might just be a blip, but it might also be the start of a big trend. And if that's the case, then we have to know that there are implications for a lot of equities. On the right, I've got the high yield corporate bond ETF. So high yield is literally anything that's not investment grade, so below investment grade. So these guys are closer to default. It doesn't mean that they will default. It just means that they are not investment grade and higher risk, right? And then you also have another ETF, which is junk, right? So these are even lower than high yield corporate bonds. So we haven't seen much activity in this ETF in terms of downtrend. But the question is, as the market starts pricing in more credit risk and investors become a little bit more careful, could we see an unwind in this HYG ETF? That could be a trade in itself, or it could just be something to watch as a signal to understand how the market is pricing equities going forward. So these are all the indicators that you have to be on top of. just to understand and have a finger on the pulse of the market. Is this market starting to get concerned about delinquency, defaults of companies, bankruptcy risk, and so on? Or is this market one where, it's going to give a lot of benefit of doubt to all these situations? At the moment, if I look at the high yield corporate bond, it's definitely not indicative of any recessionary trends or anything like that. But as you know, these things can change very quickly, right? Also, the high yield corporate bonds have been um, yielding quite high returns. So a lot of bond investors have flocked to high yield corporate bonds as the economy has held up and also been growing, while at the same time these high yield corporate bonds were paying them quite handsome returns. So there is a possibility that this keeps happening, but I think if the economy weakens a little bit here, there might be like a big unwind in this whole trade, because you know if the Fed starts indicating that the economy is weak, which they haven't yet, right? And across the board, companies are missing on their estimates and so on, cutting their guidance and outlook. I think it's only a matter of time before we see a proper unwind in this ETF as well. So as you can see, right, the last time we had this was 2002, where literally the Fed started increasing interest rates, or they indicated they would increase interest rates, uh, and then eventually that moved from 87 all the way down to 70. And as you can see, an unwind can be quite powerful as everyone is headed for the exits. And as this price is coming down, the rate of return that you get on your corporate bonds, on your high yield corporate bonds, increases. So that incentivizes new investors to come in and buy these same bonds. And eventually they reach an equilibrium price where the guys at the bottom say, look, I'm getting paid 10, 12, 15% on this bond, and the economy is still holding up. So that's a great position to be in. And I wouldn't mind collecting 10, 15% per year, and at the same time have this bond re-rate upwards, which is what happened here. So someone who bought bonds at this point over here is probably making 10% per annum in terms of interest income. And on the capital returns, they're probably making 20, maybe 30%. So actually, no, maybe another 10, 15, 20%, because this is an ETF, right? So imagine holding a corporate bond and you're making returns like what you'd get in equity, like 30, 40, 50% and upwards. So that becomes quite an interesting point for them to get involved in. But of course, if you get like a situation where the market is hinting that there's going to be a lot of bankruptcies, all these guys will just exit, and then this probably will make a new low. But even if this gets from 79 all the way down to 70, that's a good trade in itself. Or if anything, it's a good thing to keep watching. What I would watch for here is for a break below this 200-day moving average. I think this would be indicative of trouble brewing ahead. Okay, so just a bit of a few words of advice as you're trading this, what you probably would think is a tricky market. Um, One word of advice here is be tactical and trade smart. So don't panic, don't freeze, don't look at the price action and start having nightmares. Instead, look at what the market is giving you, right? Take advantage of the volatility. I'll give you one example. Let's say you've researched a stock and you're bearish on it. Let's take an example. You've researched a home builder stock. You're bearish on it, but then on Friday it went up by 4%. Now you're like, oh, but my view is bearish, but it went up. So maybe I'm wrong, right? And then on Monday, it goes up another 2%. On Tuesday, it goes up another 1%. And then on Wednesday, it's down 8, 10%, right? So you're sitting there on Monday, you don't really know what's going to happen on Wednesday. It's a high volatility environment. And if you're bearish on the stock fundamentally, I think what you should do is you should take advantage of these bear rallies and then use that to your advantage to get a very good entry point into your shorts. So you're always trying to stack odds in your favor. There are a number of things you could do to take advantage of this volatility, especially if you're trading options. But I'm not going to go too much into details because you have to put things into context. Otherwise, it doesn't make sense. I think Bourbon has a very good example where he shorted or he bought puts on one company. The next day, so on earnings day, the company was up 8, 9%. He bought puts at the top. Then the next day, the company is down 8% or something along those lines. And then he's already well in the money. And then he's got till April for that trade. So what did he do? He just shorted another put option and basically neutralized his net cost on the trade. So now the worst outcome is he loses zero. The best outcome is that he makes even more than he's already made at the moment. So you use this volatility to your advantage, and as even if the market is moving like crazy, you've already locked in really good prices in your options, and it's just a matter of how much further the market will fall, or even if it trades sideways, you're still going to make quite a bit of money. I think in my video that I recently uploaded on YouTube, I also alluded to something along these lines. Take profits as they come. So do not stay at unrealized P&L and think about all the thousands of dollars you're making and what that could buy you and so on. Book the profits, make them realized profits, then move on, right? Do not look at unrealized profit and keep salivating on it. The markets are going to move quite wildly. And if it's giving you a gift on one day, just take it, right? If you don't want to take the full profit off, just take half of it. No one actually got poorer by taking profits. That's something that's undeniable, right? I've seen a lot of people, look at a position with a lot of unrealized P&L go to zero, go to minus 100% very quickly, because that's the nature of the markets, especially when volatility is high. I've also discussed this. Do not look for validation from daily price action. So the markets will do whatever it is doing, right? If stocks are getting sold indiscriminately, you would not expect the price action to correlate well with what the fundamental picture is, right? Instead, your job is to establish what the fundamental picture is and to note that there is a big delta between where the price is trading or where it's going versus where it probably should be in the future when all this selling is over. That's literally why you get paid, right? So it's a little bit of a mindset shift that needs to happen. You should not be putting too much or giving too much credence to this daily price action. I'll show you one thing when we start looking at the charts. Just remind me of that if I forget about it. Also, as you're generating new trade ideas, make sure they all have a combination of tailwinds or headwinds. So, for example, let's say you're going long a company. You think that demand will hold up, but also, add more tailwinds to this company. If this company is low debt or has no debt and has very high quality assets, and at the same time, if this company is undergoing macro tailwinds, put all of these in your favor and then seek these type of long ideas. So just let's just put this into context, right? Demand is holding up. A sector where demand is holding up. Let's say healthcare, right? A company that has no debt versus a company with a lot of debt. Pick the company with no debt, right? So do healthcare, find a company with low or no debt, and find a company that has products that are mission critical. So products that cannot be substituted overnight. Then, like, let's take an example. Pacemakers, heart pacemakers, right? So these are not easy to substitute from one day to the other. There's a lot of things that are required before you're able to sell heart pacemakers, right? You need the FDA regulatory approval. You need to build relationships and, have a lot of case studies, have a lot of clinicians that actually vouch for your products. So the longer you've been in that business, the more of a moat you've developed. And, if you find yourself looking at a company in that space with a lot of debt versus one with little debt, pick the one with little debt. Macro tailwinds. We can clearly see that at the moment, the market is not liking a lot of mid caps or small caps. So don't go for the small caps. Don't go for the mid caps. Go for a large cap. If the market is seeking the security of large caps, go for a large cap healthcare company that has little to no debt or low debt that manufactures pacemakers and other medical equipment, right? So make that conscious shift, right? Because the market environment has changed. Capital is telling you what it likes and what it dislikes. So pick all these factors that it likes to stack the odds in your favor. And for shorts, the same thing applies. Let's say you find an industry where demand is decreasing. Just on that basis, it's hard to get a good short. What can you do to stack the odds in your favor? Find a company with high debt. Find a company where the cash flows are decreasing, and therefore the balance sheet worsening becomes a lot more of an issue, right? Find a company where they have macro headwinds. So a company that probably will sell off just on the basis of inflation, maybe because it has a high PE and then the market is trying to re-rate all the PEs downwards. So find a company within that space with all these different chunks bolted into it that stack the odds in your favor. Okay? Because the market might decide to move on only one or combination of these factors. And what you're trying to do all the time is to put all of this in your favor and then on that basis have a high quality and highly actionable trade idea. Do you have any questions here? Um, no questions. So I'll move on to doing a little bit of price action analysis. I see someone sent in a chat message. Don't worry about it, Hader. That's okay. Uh, yeah, this is what I wanted to show you. So this is the S&P 500, right? This is on a weekly basis. And as you can see, it kind of tested or almost tested the 200-day moving average and then bounced off it on Friday. But if we look at it on a daily basis, right? So on a weekly basis, another thing to note is that this trend line has been broken. So this trend line has held up quite well last time, but now it's been broken. And the question is, are we going to rally above this or is this just going to keep going down? My view is that this is just going to keep going down and try to test this 200-day moving average a lot more strongly. What's happening is a lot of funds are, they are stuck. So they have no way out and they have to sell at the moment, right? And as the selling starts, a lot of the retail traders in the US will start selling as well because, you know, they've enjoyed for the longest time the biggest bull market. So a lot of these guys, they probably bought here and they're thinking, yeah, this is a great place to buy the dip, right? And then the market keeps going lower, and then they have to keep selling, and that drives the price even lower, right? So from my perspective, the sell-off is not over. So what I wanted to also show you is if we look at this chart on a daily basis, just pay attention very carefully, right? So this is a daily basis chart. So almost every single day we've been selling off, except from Friday and Wednesday, right? Just look at the price action very carefully here, right? So this is Monday. It broke below this trend line and then closed just at the trend line. On the next day, it opened and then immediately went all the way down and closed below this trend line, right? So that's a sign that the trend line is broken. On the next day, the price tries to test this trend line again, and it doesn't. It's not able to. It fails, right? So a lot of these guys who have been short here are short or covering and taking profits, and then as the market is going up, a lot of the bottom fishers, they get in and they think, okay, maybe this is a chance for me to buy on the cheap, and they buy, and then eventually you have institutions that keep selling, right? So the price never manages to get above this trend line. The next day, price opens lower, forms a new low, right? And then on Friday, we open lower, and then somehow towards the end we closed higher, right? So just looking at Friday's price action, you cannot tell me that the sell-off is over, right? What are we seeing here? What is the distinguishing sign in this whole trend that we are seeing? Are we making higher highs or lower highs? So highs mean this is a low, this is a high, right? So if you look here, you're making new lows, right? Agreed? It tries to make a high, and the high is never a higher high. It's a higher high would be somewhere here. It's a lower high, and then we make lower lows. Lower highs, lower lows. Lower highs, lower lows. Lower highs, even lower lows. Lower highs, you know, then we might be somewhere here next. So this is something that's very powerful. Keep a look for this because this is confirmation sign that the sell-off is happening and it's not about to finish, right? A big trend has been broken. It's causing a lot of pain for many of the guys who've been long the stock market, and this sell-off is just in its initial phases. Do we have any questions here?
Roshan, so when does this thing turns? Like, what kind of signal will break this trend, and
Um,
you would think like the sell-off is over. What should have happened for that?
we can look at evidence here, right? So this is probably July to August, yeah.
Yeah.
Not as big of a sell-off, but still quite a bit compared to previous months of volatility. So if you looked here, yeah. So if you look here again, a series of lower lows, lower highs, right? So here it tries to make a higher high, higher compared to the previous high, right? And then this doesn't hold up, sells off even more brutally. And I think this is where the sell-off is done. So how do you recognize this? It's not that easy, right? we let's say this is Friday's price action, right? We haven't seen this story or this movie at all yet. As this rally is here, you're still skeptical and you're like, no, this is still part of the sell-off. And then this tries to rally, but then sells back down, and you think to yourself, um, I think we're still in that selling phase. And then it keeps going higher. It keeps making higher highs, right? And then I think once you see a string of these higher highs, then you get a little bit more confidence that the sell-off might be over. At the same time, you'll see that the VIX index is going to come down quite significantly. So this is something I wanted to show you next. So at the moment, um, VIX is still closer to the highs than to the lows, right? VIX is at 23. It's gone as high as 26.6, right? It's not yet come back down significantly, right?
Yeah.
And if you were to look at the behavior in, this is hard to find. Um, yeah, this is actually the behavior in July when there was this carry trade unwind. So quite brutal, right? We went all the way to 65. Okay, so this is start of August, right? You see the bottoming action as the VIX just crumbles through, and then every single day it's going lower. Maybe what I can do is if I overlay this on top, let's try this. Okay, so this is July. So look at this, right? In July, VIX is around 13, and then it creeps up, right? Gets into 20s or close to 20. So the sell-off starts as VIX creeps up. And then there's even more sell-off, right? The bigger sell-off happens towards the end of July. And that makes the VIX go really high. But then you see, immediately VIX comes back down quite significantly. So it goes from 66 all the way to 33, and then it just comes back down to low 20s and eventually to 15. So do you see where the turning point happens?
Yeah.
Right? So, of course, our job is not to pick the bottom. It's impossible to pick the exact date of the bottom, right? But as you see this, right, there's a big sell off. So, a lot of selling has happened. And then VIX comes back down over the next few days, right? The stock market rallies, maybe even till here, right? Because here you're trading at around, let's say, 23. You'll probably say, I'm not sure whether the sell-off is done, whether this is a fake rally or not, right? And then the next day, you get another tick lower in the VIX and eventually another tick. I think by this stage, right, if you decide to re-enter, that's a good place. You don't need to be in here, right? You can wait for a lot of confirmation signals, because also remember there's a whole macro picture happening at the in under the hood, right? So there's a lot of data that's also coming through, and I don't remember what was coming out at that point. Could be inflation, could be ISM, and so on, right? So a lot of these would also have influence on what the stock market is doing. But this is normally when the VIX comes back down from its highs and comes back down quite quickly. This tends to be a good signal for all the selling being over, and that being a bit of a turning point in markets. You see it here as well, right? I think you see it somewhere here. But this was never really like a sell-off, right? The market did not sell off that much. So at this point, if on Monday we come in and then VIX just goes to 30, 35, the S&P is going to be much lower, right? And then if it goes to 50, 60 and all of this, uh, this is probably a sign that there's only two possibilities from there. One is the market just goes into a tailspin, right? We have a proper market crash. Or if the VIX goes to, let's say, 50, 60, and then in the next few days, it comes back down to 30, 20, 15 over the next, let's say, 5, 10 days, then that's a signal that a lot of the sell-off has probably been done. And now you can start putting longs in your portfolio. Remember, when VIX is above 20, you don't want to be a portfolio manager. What does that mean? A portfolio manager is someone that's actually looking at a stock and then buying it for 3 to 6 months ahead. So they are buying the fundamentals that will come maybe 6 months later or 12 months later. When VIX is high, you want to look at things, you know, as of now and figure out, will the market like to hold this stock in this volatile environment, or will the market just ditch this company, right? And especially VIX doesn't creep up for no good reason. If it's creeping up because, let's say, inflation is out of control or there's default risk increasing in the market, delinquency risks in consumers is going up, these are real fundamental deterioration, right? So the VIX is spiking for a good reason, and the stock market will sell off for a very good reason. And then the driving factor of what's making the market go up or down will have to be identified. And with that, you have to follow what's happening on the ground and figure out for yourself if this is the bottom or not. So there's a combination of factors, right? It's highly contextual. And our job is never to pick tops or to pick bottoms. If we can do this, great. But that's not something that, we obsess about. What we care about is where are things going to be, let's say, in the next month, right? Is that clear?
Yeah, makes sense.
Okay. So I wanted to go through a few indices. So the first one is the consumer discretionary in ETF. So I'll go back to the weekly charts because my indicators are set up for weekly. So this is one of the ETFs that have almost led the sell-off. So the consumer discretionary and tech, both of them. It's had quite a big sell-off so far, and it looks like it's about to bounce off this 200-day moving average line. Keep a close eye on this because if this breaks down below, it's gonna go much lower. And there are many companies within this space that still have a lot of room for correction, right? The US GDP, the US consumer spending is 70% of US GDP. So a meaningful slowdown there spells a lot of trouble for the US GDP. And with that, companies that are directly involved in consumer discretionary segment. So that's a big one to keep looking for. In line with this is the retail ETF. So these are the retail companies and so on. This one has broken down properly. It's already broken down technically. So now the question is, do we see a bounce back and test this level? I highly doubt it. I think this is probably going to go even lower. So, Bhavan, this is where you are winning at the moment, right? With Burlington. So, this is something to keep watching for. Does this ETF make new lows? I think it could potentially do that. Any questions so
Mhm.
far? Not really. Okay, so semiconductors, very important for us to watch because this is highly cyclical and it's highly linked to US GDP. So if you think about it, everything that's around us has chips these days, right? And if semiconductors are not doing well, it also is a future or leading indicator on what US GDP might be in the future. So semiconductors have been propped up by this whole AI theme, and rightly so. And now what we see, it's broken down below the 200-day moving average. It's still holding on this trend line here as a support level, but keep an eye on this, right? If this goes lower, I think we would potentially enter bear market territory in the markets. So as you can see in my head, I'm not yet sure whether this is a correction or whether this is a proper market crash, a proper bear market starting. We'll only know in hindsight. But what we are trying to do here is to have a lot of things to watch that give us a very good indication of what's about to happen. Okay. Uh, what else did I want to see? Okay, I think we can look at this. So this is the industrial sector ETF. It's held up quite well, right? It hasn't sold off a lot. It's held up quite well. And a lot of it has to do with this whole manufacturing onshoring. And also the ISM PMI it wasn't the best of reports because the new order index was contractionary, but at an index level, at the broader ISM level, we still had a little bit of expansion. So people are still not overly concerned about industrials at this stage. And this is a space we need to keep watching for. Also, guys, look, what I'm sharing with you here is a shortcut for you to get a very good understanding of what's happening under the hood in the economy. These ETFs are a reflection of all these industrial stocks, right? If they are going up or going down, it definitely happens because of real fundamental reasons. Price in itself can be a big indication. It can be the biggest leading indicator sometimes. And if you see these ETFs react in one way or the other, especially when there is a technical breakdown, you should start doing a lot more research within that space and identify what's driving that, because there's a lot to play in these spaces. If this is breaking down technically, it's not happening randomly, right? It means that there's something fundamentally that is projected to be far worse than what was expected before, and this would lead to meaningful downside in a lot of equities. Do we all get that?
Yeah.
I'm trying to find the materials one. It's XLB, yeah. So this is the materials ETF. So this is basically everything that goes into industrials. So the feedstock, metals, chemicals, and all of these. Yeah. If you're ever in doubt, you can always Google, right? You can say XLB constituents, and then look at the companies within, right? This company manufactures paint. This company manufactures industrial gases. This company manufactures gold. This one manufactures copper. Linde, that's industrial gases again. So things like pure oxygen, that's used in industrial processes for welding and for chemical processes and so on. So if they are contracting, the share prices will also perform accordingly, right? It would reflect the poorer outlook of that industry, and that gives you a very good indication of whether the economy is growing or not, right? Especially within chemicals, because chemicals are the foundational industry. What do I mean by this? Everything that's used by the industries in terms of feedstock is produced by the chemicals industry. For example, ammonia, pure oxygen, what else? Like base metals, industrial metals, copper, steel, aluminum. If these companies are not expanding, it means that demand is low ahead in the value chain, right? So if demand is low in the next part of the value chain, you can immediately understand that there's something that's impacting this whole value chain, and it's your job now to go and play a bit of investigation and figure out exactly what's driving this and what's about to happen next. So this is basically how we hunt for trade ideas and how we get very good, high quality, actionable trade ideas. I'll do a last one, XLP, which is the consumer staples. As you can see, this is on a tear. So clear-cut defensive move, risk-off move by the market. It's moving away from consumer discretionary into the safety of consumer staples and the likes of it. So if the market reverses and there's a rally here, I think this space will have a lot of companies that are potentially shortable because you basically get the opposite end of the capital rotation where a lot of this money that was parked for security then just comes out of these companies as they seek to go to higher growth companies and industries, right? So that's another tradable theme for you, but it's not for now. It's for when the market has bottomed and you think that the risk on behavior will be back. Bhavan, just to answer your question, how would we know whether the stock market has bottomed? When we do the price action analysis, we'll also sift for all these risk on, risk off behaviors. We need to see confirmation that the market is getting a lot more risk on, right? Because if we stay in risk off, it's it could have bottom, but then it's kind of we're not going to be sure about it. It's not highly confirmatory. But as we have a couple of weeks and back-to-back weeks of risk on behavior, then that gives us a lot more conviction that the market has potentially bottomed and that we are probably headed for the next leg up. Okay? It's always the same, right? Across different cycles, this is always what you'll see. Yeah, finally, this is what I wanted to show you. Let's go on to Koifin. Is this helpful?
Yes, very much as usual.
Yes. Yep.
As the market environment changes, you also have to change the things that you're looking at, right? Because you're always trying to be one step ahead and try to make sense of what's driving all of these, whether it's a sell-off, whether it's a recovery. And this is the reason why, I mean, typically we don't look at a lot of these things, but now we're looking at it well in details, understanding whether there's a technical breakdown, whether something is, doing the opposite of what it was doing in the past. And the whole thing behind it is we're trying to understand what capital is doing in the background. So what I wanted to show you is this is basically I'll just widen this, maybe do 5 years. So this is the credit risk premium that the corporate bond market in the US is adding on top of risk-free rates. So just very quickly for people who are not familiar with how bond rates are priced. So the baseline is always the risk-free rate. This is basically the interest rate or the Fed funds rate in the US. And then depending on the level of risk that you perceive is going to be in the loan that you're making, you will add a premium to the risk-free rate. So for example, if you're lending money to Apple, you probably would say, okay, I give you the interest at risk-free rate plus 1%. If you're lending money to an oil rig producer or an oil producer or an oil driller, then you probably will say, okay, this is a little bit of a risky business. It's cyclical. You're not the best of companies. You already have a bit of debt. Your cash flows are not looking that strong. So I'm going to give you risk-free plus 8%, right? And just to sum up on this conversation, the longer the duration of that loan, the more of a premium you'll tend to add, because there's a lot more risk as you take more duration, right? That's called duration risk. But for our purposes, what we care about here is what's happening to this premium, right? If you see, this is in the middle of COVID-19, and then as the Fed stimulated, this went all the way down. So we're looking at US high yields at the moment, right? So not the investment grade segment of the market. And for the longest time, right, this is not something we've been even watching. It's kind of been cruising at these lows. And then now from February, let's say 14th onwards, right? Like as a Valentine's gift, this credit risk premium starts creeping upwards. So the question is this just a blip, or is this going to be, another significant rally in this credit risk premium compared to, if you look here, right? Let's say if we're here at the moment, this is a pretty steep increase in credit risk premium. And if you look at equities, especially, there are equities that are very sensitive to this segment. You would have seen that during this phase, they were selling off quite significantly. So the question now is this just like a blip, or is this just going to keep going up as market perceives that there's a lot more risk, especially if the economy is slowing down? So the question really here is, if the economy is slowing down, right? How will that impact the stock market? Obviously, it's not going to be positive, and then this credit risk premium is going to go much higher. Because think about it, right? If you give someone a loan, their repaying ability depends on their income, right? If the economy is going down and you've given loans in segments that are highly cyclical, which means that they are highly linked to economic growth or highly even levered to economic growth, if that economic growth is coming lower than expected, the cash flows will also dwindle, right? And with that, that particular company becomes a lot more stressed. And if you are to give them a new loan, you have to price that in, right? So these companies, which are highly cyclical, we've seen them. I mean, there have been many companies in the past, even large caps, that have filed for bankruptcy. Noble Energy as an example, so many others, right? So the question is, are we at the start of this cycle, or, is this just something that is momentary and will fade eventually? If you have Coifin, you can do this analysis across the high grade end of the market too. I'll just do it quickly. So if we do it, let's look at this. This gives us an idea of duration risk. What is this? No, this is emerging market. Okay, I should just get rid of that. Right. So as you can see, not much to decipher here. It's creeping up, but it's a very, very small increase, right? The market is not necessarily that concerned with duration risk either. So that's what I make of it. The stress will appear first within the high grade and junk segment of the market, and then later on within the investment grade. So I mentioned the junk bond ETF earlier. This is the ticker symbol, JNK. This is something to watch alongside the HYG, which is the high yield ETF, right? So keep a lookout for these. I would not be surprised to see meaningful movements in these in the next few weeks. Okay, that's all I wanted to showcase. And then maybe we'll do some analysis on the sectors. And then I want to move on to the rest of the presentation. So I'll go over this quite quickly. We're all fairly used to this now. So the S&P is down 3% on the week, believe it or not, right? And then basically what we would consider is these are the sectors that have underperformed the S&P: technology, energy, consumer discretionary, financials. So a very risk-off behavior here, right? The sectors that have outperformed the S&P: healthcare, risk, again, defensive, risk-off; consumer staples, defensive, risk-off; materials and industrials, these are cyclicals. So quite interesting to see that they still outperform the S&P. So in other words, they did not fall by as much as the S&P. Of interest would be the fall in financials, right? Does anyone know why financials is probably selling off? Do we have an idea?
The delinquency rates,
Delinqu-
yeah.
Yeah, potentially. Yeah. It's quite a big sell-off, right? Like 5% or nearly 6% on the week at an index level. That's a lot. Yeah.
That's also a margin compression, right?
Yeah. So there's a couple of things here. If the economy is not going to grow as quickly, the growth of new loans will be curtailed, right? So with that, fee income will also be curtailed. Net interest income is also looking like it's peaked out. So there's a confluence of headwinds here, right? And at the same time, right, as the top line is looking a bit weak on the growth front, you also have a bit of compression in margin, and even worse, you have increasing delinquency risks that basically just eat up, the earnings of the company. So that's predominantly why it's happening. And this is probably the first week where we have financial sell-off, if I'm not mistaken. And what a big sell-off in the first week itself. First or second week, I think last week was also a bad week for financials. And if you see here, this week, the regional banks were the worst of the lot, right? So that's a big signal, right? Because these guys have been leading the rally. They've been leading the rally in financials so far, right? Look at this. Why is it so pink? It's so pink that I cannot even see it. There's no contrast. There must be a way to change this, yeah? Anyway, uh, you can squint, right? Okay, so look at this. It's been leading the rally, especially with the Trump election. It just got crazy. And now it's making a new low. So that's something to watch for. There's a lot of money to be made here, right? In no unequivocal terms. We saw gold miners go back to the top in terms of performance as the gold price holds up. Quite positive price action in agriculture too. That's interesting to see. Solar home builders, that's the one that keeps me awake at night, right? I think there's still a lot of hope within this segment that interest rates are going to come down and it's going to be the panacea of everything. The market is basically just refusing to see reality in front of itself. You have building material costs that are inflecting, and it's going to get worse with the tariffs, right? Whether it's lumber, whether it's steel, whether it's anything else that's used in construction, like insulation material, boiler, and so on. Then you have home builders with the highest level of inventory. Demand is not necessarily increasing, right? So the prospect for building new housing is relatively low at the moment. the home builders sentiment, and that's predominantly the smaller home builders, it's at an all-time low, right? And yet the market still does not want to accept that, this requires a big correction from here. We'll see who wins at the end of the day. I still think this is going to go down. This is probably, if I were a big home builder short, I would probably be taking advantage of this weekly rally and then put in more shorts and, use this to my advantage to structure great trades here. Nothing much else to discuss. Of course, oil and all of these others are down. Retail is also down quite big. We've discussed this already. I wanted to move quickly to the factor analysis. So on a monthly basis, what we can see is the market has basically just sought the protection and safety of large cap value. So that's at the detriment of all the smaller segments. And, growth has sold off quite a bit. And as with the company size, as the company size goes lower, the sell-off is even worse. So this is purely because of a risk-off move, right? If you recall that risk spectrum that I showed you in one of my slides, this is literally happening in real time. Capital is moving to the far right, which is risk-off and safest, and moving away from the far left, which is basically small cap, high growth, and so on. Okay, do we have any questions? You guys can see all of this on Coifin, right? Even in the free plans, or do you need a paid plans to be able to see these? Can anyone confirm?
I've taken a look at some of them. I guess I haven't gone in so much detail, but I think some of these features are definitely available.
Okay, that's brilliant. That's actually brilliant because this is incredibly helpful, to have all of that in one place. And there are not many platforms that will give you all of it in one place. You probably need to, type in 1 million of ETFs on your trading view and then compare them manually. Complete waste of time. So let's get into the second part of the presentation. As we've seen, consumer sentiment has been weakening, and it matters a lot, right? US consumer spending is 70% of the US GDP. US consumers are acutely aware of inflation and how it's eroding their purchasing power. We've seen this in the latest consumer sentiment survey from the University of Michigan. One thing that people don't realize is as stocks are falling, this is reducing the portfolio value of a lot of people. It's reducing the wealth effect, and these people are less inclined or more fearful to make discretionary purchases. They might have the money, they might still be able to afford it, but it's just a sentiment thing, right? The wealth effect is something that's very much real. As the stock market comes down, the wealth effect comes down quite significantly. I think what people will do is they will adopt a wait and see approach, just see whether the economy is holding up, just see whether the job market will stay strong before they start making discretionary purchases. Discretionary purchases can always wait, right? The other thing that we have to keep in mind is property values have held up quite well over the last few years. People have a lot of equity in their real estate. If property prices start falling, there might be a rush to sell to crystallize the equity. So what would that do to the property prices? Probably make it go down quite a bit. Although at the time we're speaking, if building costs are increasing, land costs are increasing, and there is a bit of a deficit in terms of US housing, it's a bit difficult to see how prices come down. The only way this comes down is if the existing home inventory starts increasing quite significantly because people are in a rush to crystallize their equity. So that would lead to a lot of selling activity, and I think eventually price will have to correct. And that's even worse for home builders because they'll be holding inventory of houses that have been built at relatively higher costs, and they might not be able to make a profit on a lot of this inventory. So if this inventory goes underwater, that's a big problem for a lot of these companies. I think you could even start seeing a bit of bankruptcies and so on. We're far from there, but you always have to look 6 to 12 months ahead and understand what could happen given how the chips are set up. At the moment, we're not seeing existing home inventory rising because people have 30-year fixed rate mortgages secured at very low interest rates. So there's not much of an incentive to go out, cancel that mortgage, do the home sale, and buy a new house with a new mortgage because rates are too high. And, the 30-year fixed rate mortgages are literally a privilege at the rates that they've been able to secure them. So the need to crystallize the equity is not yet being felt. It will become felt once people start, let's say you drive on your street and you see a couple of houses for sale, then the sentiment might start changing. And especially if property prices come down too. Go ahead. I see you've got a question.
Yeah, Roshan, yes, I believe these are 30-year mortgages, but correct me if I'm wrong, but don't they have to refinance it every 5 years?
No,
And so I guess the interest rate is only locked in for 5 years.
No, these are 30-year fixed rate mortgages. So for the full term. So there are different types of mortgages. There are the adjustable mortgages, which is what you're talking about. The one where you get a fixed rate for the next 3 to 5 years, and then you have to go back to the bank after 5 years, and they will tell you what the rate will be next. That will be a factor of LTV, the prevailing interest rate at the moment, and so on.
Got it.
Is
Thanks.
that clear?
Yes, that is. Thank you.
So you know what happened, and it's probably something for you to do a little bit more research into. You'll find a lot of great information in this space. As the rates were at all-time lows, right? People were just taking advantage of. Some people have 30-year fixed rate mortgages at like 2.5% per year. Think about it. Because rates were like 0.25 or something, right? And for the longest time, people have been taking massive advantage of these low rates. And now, it's a privilege for them, right? They're not going to want to get rid of that unless they are compensated very handsomely, right? Or if they have a real need for it. And that would typically be out of fear, out of an economic situation. So keep an eye on this because this is literally how the deck of cards is set up, right? We don't know how things will work, but we know very well what's the status quo. And as the economy progresses in one way or the other, we'll get to understand a bit more and we can always revisit the status quo and figure out what's happening. Yeah. When things are happening, it's too late to go and do research. You need to be building these research and monitoring over months for it to really sink in. And then you'll have the conviction to pull the trigger when you actually think there is a trade or, an opportunity in the market. And the housing market is quite complex, right? There are different segments, different ages, different types of products, mortgages. It's very complicated. So to be able to distill everything in the high, from a high level, and still be close enough to see how the picture is unfolding, it's a little bit of a skill, right? And this is why I've been kind of preparing you from, I think, July of last year, right? When I was speaking about housing and the whole setup with mortgages and all. The whole reason behind it is because when it happens and I tell you it's happening, you know exactly how the whole dominoes are stacked up and what's about to happen with relatively high level of conviction next. A large part of why we never panic is because we are always well prepared, right? We panic when we are faced with uncertainty, right? If you get attacked by a dog tomorrow, you'll panic because you don't know how this will end, right? You're not prepared for a dog fight. But if you, let's say, you've been training in self-defense for years and then someone tries to mug you on the side of the road, you're not going to panic, right? You'll handle it quite calmly. You'll of course try to avoid conflict, but if it escalates, you're not going to panic, right? Because you know you're far better equipped than your opponent. Right, let's get into the meat of this now. So if you are all still awake, right? What does this all translate into? As we're looking ahead into the next few weeks, what are potential short trades that we can have? We have a slide on longs as well, but let's look at shorts because they are a little bit more topical at the moment, right? So one thing that we could look at is highly discretionary, highly indebted companies or companies that require people to take on debt to buy their products, like autos. What I've got here is one example, Harley Davidson, ticker symbol HOG. So I'm sure you all know about this. This is a company that manufactures motorcycles or motorbikes. I'm not really a big enthusiast of that space. So if I get anything wrong here, don't crucify me. It's till date, I don't know why people buy these things. For the same reason why I don't understand why people buy supercars, right? Because if you want speed, just get on a plane, right? Why buy a supercar and then get stuck in traffic with it? I never understood that. But let's not digress. So HOG, I think I should also maybe give you a bit of a disclaimer here. So whenever I'm mentioning these ideas and themes, these are not for you to take and put in your portfolio right away. These are for you to research, right? So if I were you and I'm on a webinar like this and the guy mentions, okay, the reason I'm looking at Harley Davidson is because they have a lot of debt and they're also in a highly discretionary segment. I'd be like, yeah, this is an interesting theme. Do I put Harley Davidson on as a short itself? I'll just go and do some research. It recently had earnings, looked like it missed. The market wasn't too happy about that, so it's trading flat since earnings. Is there more weakening that could happen here? I don't know. You have to go figure it out. But if you really want to learn this properly, what you would do is you'd say, okay, he said Harley Davidson, right? Let me just take a quick look at the fundamentals of this company. What I would do is I would look at this and say, okay, so market cap is 3.25 billion. It has debt of 7 billion. That's quite a bit. Okay, so I can maybe just move this up. Yeah, so it's got debt of 7 billion, quite a bit. Cash of 1 billion. Okay. We know these guys manufacture motorcycles. What have earnings been like? Not the greatest in terms of earnings. It's been contracting. What about sales? Contracting as well. That's a good space to be as a short. The question is always, has it already moved enough and there's not much more opportunity, right? So you probably would want to look at the financials a little bit, right? Maybe you look at this graph here and you're like, okay, I can see revenues coming down, EPS is coming down with it. revenue is coming down a lot. So let's just do a bit of an analysis to see whether they have debt issues, right? I'm not going to show you how to do this now. It's just going to take a bit too long otherwise. But you typically want to look at this, right? You typically want to look at net interest expenses. So it's around, let's look at on an annual basis. It's around, actually they don't even pay interest, right? They receive interest because they have a huge cash balance. So that's interesting. You want to see what's happening to revenue. It's been down 11%. And now the question for you is, what would happen if revenue keeps going down? What would happen to cash flows? Is this going to become a problem for the company? Let's just take a quick look. So at the moment, it's still producing a high level of free cash flow. I wonder how. Net income is this much, and then, okay, it's probably divesting some of its operations. Let's just quickly scan through this. Okay, change in inventory. Anyway, you would need to do a bit of a deep dive into the company just to establish what's happening. It also has a high, relatively high level of capex it needs to do every year to maintain its factories and so on. So it's also repurchasing its stocks. So that's something that's useful to know, especially if you're going to short it. But most importantly, what a clever person would do is he'd say, okay, that's just one idea. Let me look at its peers. Can I find a short idea, let's say, in this one? This is Polaris. It's a manufacturer of recreational vehicles. So, all these off-road vehicles, these quad bikes and so on. This company manufactures these types of products. And then you can see, right, you've got more companies that open up in that whole discretionary leisure product space. So this is literally what you would do with all the ideas that I'm sharing with you here. It's not to do not just go and put these ideas. I'm giving you food for thought just to trigger some further thinking and understand where are good areas to short and to go long. Okay. Moving back here, I think there's also credit risk and increased delinquency risk that is being priced in by the market. So this week we've seen a bit of sell-off from Capital One Financial. It has a high exposure to subprime lenders. Ali has a high exposure to auto lenders. Symphony, it issues credit cards that's basically being used by retail, right? So if retail is contracting and at the same time delinquency risks might be up, right? This could potentially give us a good short idea here. You've got credit acceptance, CACC. It has a high exposure to subprime lenders within autos. OMF, it has high exposure to subprime again. And then you've got QFIN. So this has a high exposure to China. So if you're not that positive on China and you want to have a play, you can always look at companies like QFIN. And the whole idea here, guys, is what you could also do is you could just type in OMF, for instance, right? Because I think the weakness that I'm seeing within the group is that there is not a wide universe that you know about in terms of companies that are within a specific space, right? For instance, if I tell you auto lending, you probably don't know much about this universe. And it's absolutely normal. This comes as a function of doing more research. But this is the time for you to really level up your game, right? And to widen this knowledge base. So if I give you a company like OMF, what you could also do is you go to TradingView and then you click on this industry here. It's within the finance, retail, leasing segment. And then that's going to open up a lot of its peers. So these are not like actual peers. They would be within the similar kind of space, but you'd be able to make to find a few names that are similar. So from here, you can pick a few names and do a bit of research, and instantly you know more about the industry than what you knew before you did this exercise. Within an hour, you'd be far more knowledgeable. So whenever people struggle with, okay, I don't know which company to trade, if you say this is a potential theme, it literally takes a couple of hours just to, become far more knowledgeable about this tradable universe. Which company does what, and what are they exposed to? In what situation would you be long or short these types of companies? This is literally what you're asking yourself every time you do your research. And then I think what we might be also seeing is a bust in credit, in private credit. So companies like Blackstone, uh, there's a lot of things going on, which I'm not going to cover. So there's Blackstone, there's KKR, there's a lot more you can, find out on your own. So basically, what these companies do is they take investors' money and then they invest it like a fund would do. But the only difference is these are invested in private credits, private credit agreements. So the problem here is that private credit, let's say it's a debt given to a corporate, right? That type of instrument is not tradable. So there is no mark-to-market price. And then what these companies have been doing is they've basically not reflected the valuations of the holdings in line with fair value. So because there's not a market value, they've kind of been playing with investors and, eyeballing the numbers higher. At least that's my suspicion, right? So now, as the market is coming back and investors are, let's say, looking to get their money back, and these companies are having liquidations and they have to sell assets to be able to help with redemptions, then they eventually get back to reality. They will only be able to sell at what the market perceives to be fair value. And at the same time, everyone is now realizing that this is a game that has gone on for far too long, and that whatever they had been putting into their prospectus or sending out to investors is not necessarily reflective of reality. So once again, this is a big problem when it comes to the perception with wealth effect. Because let's say you were a wealthy individual, you invested 100 million with one of these companies, and every month or every quarter you've been seeing your fund or your pot money go up significantly or consistently, right? This is just made up valuation. People just put a number there. It has zero basis. It's not mark to market. And the real value or the only return you've made is on the exit, right? And as you want your money back, you probably get 50 million. And that's because the market is not willing to pay above this. And people realize, oh, actually, I thought I had 100 million in that fund, and they told me it's worth 150 million, but then I only got back 50, 75 million. This is a big problem, right? When it comes to the wealth effect, it just chips at it significantly. So you can look at this as another area for shorts.
Roshan, one quick question.
Yeah.
This theme look like I haven't done the research, but it wouldn't come in the earnings report, right? How did you get this information that the liquidation is being sold at less than the market value what these companies are booking in their balance sheet?
Think about it.
I mean, it makes sense to me, but how did you?
Think about it. The public markets have been correcting hard, right, in tech. And then if you compare the same numbers with the private markets are supposedly not correcting. Same space, same types of companies. Just because it's private, it doesn't undergo a correction. But this is not realistic, right? Because if you are about to sell the company, or whatever investment you have in that company, the market will always use the public market as a comparable. So eventually you will all go back to market. And how do I know whether there's liquidations or not? You have to do your research. Once you start doing the research, you will know. You need to be following this space and understand how this whole thing operates. This whole topic of venture capitalism, private equity, and all of this, it's all very murky because it's not transparent, it's not public. But when the bust happens, it happens in public.
Nice. I think it's a very good idea.
Yeah. I mean, when things are going well, no one redeems, right? People just say, oh yeah, all is good. But think about it. If you have 100 million with Blackstone, you have let's say 200 million portfolio equity that's been chopped by 20%. You're not going to be in a mood for giving more money to Blackstone. Instead, you probably would want to, liquidate all your investments, go into cash, right? If all your rich friends are moving to treasury bonds, you're also going to be thinking along those lines, and you would want to liquidate and move to US bonds. Then you give a call to Blackstone. They're like, okay, but the amount we would be able to realize is only this much. So that's the moment of truth. Just look at the price action. Tell me whether there's a situation happening in this company or not. This is Blackstone. Right? Is this enough for you to start investigating? Of course it is. Yeah?
Yeah, 100%.
Like a continued sell-off since November, right? It had a bit of a relief in Jan, and then it just goes down. So this is what I talk about, taking advantage of volatility. Market comes down and then has a rally. If you start putting your puts somewhere here, right? Instead of getting your puts here, if you get it somewhere here as the market is rallying, that's far better risk reward. And then it just, crushes down further. Give you another one. TradingView doesn't want to load it. It's too scary.
Too bad.
Okay, let's try again.
Because I know these companies are huge, like
Yeah, they're massive.
massive.
They're massive with a lot of perverse interest as well. So look at this. Yeah. You know what's happening? A lot of like I mentioned, a lot of funds are highly leveraged, right? They have this fund of fund concept, which means that they invest in other funds and so on. And as the market sells off, they all want to liquidate and, just show cash. And then from there onwards, decide whether they want to go into bonds and all of this, or whether they want to go overseas and whatnot. And when they look for the cash, this is actually what's happening. Yeah. I mean, in this case, the relief rally was even better. You went back all the way to the highs, right? And you got to short it even higher. But let's not waste too much time on this. I have something else I want to discuss quickly. Okay, sticking with potential short trades. So what you could also look for is cyclical companies that have high capex. So remember, capex can be divided in two parts: maintenance. So this is for the company to exist. And then you've got growth capex. So capex in total is maintenance capex plus growth capex. Growth capex is basically like setting up new stores, buying new factories, building new facilities, and so on. So in a downturn, people can reduce growth capex, but maintenance capex is a lot more difficult to reduce because that's required for the day-to-day operation of the company. One company that I've got here, United Rentals. So basically, it's missed earnings. It's trading below the 200-day moving average. What does this company do? It's involved in equipment rental, so heavy equipment rental. So for instance, if you need a crane, a tractor, these types of, let me see if it gives a bit of description here. So yeah, if you need safety equipment, power, HVAC equipment, fluid solutions equipment, mobile storage equipment, modular office space, all these heavy equipment, high capex type of, or high capital or capital intensive type of situations. So if you're going into an economic decline, right, of course, this type of activity will be reduced. And then these guys they still have high levels of capex to maintain all this equipment. And if they don't maintain it, then the equipment value goes much lower. So they have to maintain it. They have to spend the capital to keep everything functioning well. And at the same time, what's happening is demand for their products might be going lower, especially true in an economic downturn. So look into its peers. I think that's a very good area for shorts. You've got Caterpillar. I think it rhymes well with the previous company. So highly cyclical with global PMIs. The only thing here is China might be stimulating, and then if we have a resurgence in activity there, this might play against you as a short. But I don't think the market will take care of that. Will give too much importance to that, especially if things in the US is slowing down. Another one, quite interestingly, I think I've mentioned it to quite a few of you. With all this talk of retaliatory tariffs and so on, right? There might be a situation where combine this with global GDP maybe not growing as quickly, where global trade declines. So this week we've seen that the net imports or the imports and exports from China both missed, and quite significantly, right? This is not great for global trade because, as we know, China, India are quite big drivers when it comes to this global trade. And if the economy in China is slowing down and that's showing up as lower international trade, the global trade would also decline in line, right? Especially if the US is slowing down. So what that gives us is a situation where you might have excess supply of container ships, and then you have literally demand destruction. So you have too many ships fighting for too few contracts, and then the shipping rates go down. And with that, these companies that have or they own and lease container ships would potentially go down quite significantly. You've got DAC, CMRE, GSL, and a few others that probably are sub 1 billion market cap, so a bit more difficult to trade with options. But this is a theme that you can look into. You can move to another segment too, not just container ships. You can go to dry bulk. Just to illustrate the difference, container ship is basically the ships that carry containers, as the name would allude to. And what's in these containers is basically goods, like it could be cars, it could be furniture, equipment, electronics, and so on. Compare that with dry bulk. Dry bulk is basically they basically carry things like iron ore, grains, like soybean, rice, and all these agricultural commodities. They also carry like gold and so on. So that could be another segment where you might think there's a bit of opportunity as a short. But the theme in itself, I think it's a solid one, especially if we get resolution of the conflicts in Israel and Gaza. Actually, the conflict is not in Israel, it's in Gaza. What would that do? It would open up the Suez Canal, where a lot more ships will go through the Suez Canal. And at the moment, they're going all the way around Africa, which means that it takes them longer to complete their journey. So if the journey shortens, it means that these ships are more available. So there's higher supply of these ships. And at the same time, demand is also potentially going to decrease. So that's highly deflationary for the shipping rates. And everything in shipping, whether it's the net asset value of the vessel, whether it's the equity, all of these are determined by the shipping rates, basically cash flow driven. And quite a few of these companies would typically also have a significant level of leverage. So if this goes south, I think there could be a lot of sell-off here. You could also look at contractors that could experience a fallout from US government expenditure cuts, audits by these guys from Doge. So do a bit of research. I'm not going to give you actual names. There's one I've given you, which is CDW, but do your own research and figure it out. And then finally, consumer discretionary high PE stocks. So these are your high growth, high flying restaurants like Kava, Wingstop, Shake Shack, Brinker, ticker symbol EAT. Again, do your own research. So Costco reported on Thursday and they noted an increase in food at home products. So that's giving us a very good indication of what people are doing. They are eating out less, right? And that's to do with inflation and, the whole purchasing power being eroded. So at the restaurant end, what could happen is demand goes lower or doesn't grow as quickly as it was projected. Then input cost inflation bites into their margins. And also, inflation can slow down the expansion plans as building costs rise and chip the ROI for new franchisees. So there's quite a bit in here. As I've mentioned, you always want a multiple headwinds in these types of companies, in these types of shorts. At the moment, they were priced for high PE because they are expanding quite rapidly, which is giving a big boost to their EPS, to their revenue numbers. But if inflation is chipping at the margins, that's going to reduce the earnings growth. And at the same time, if franchisees are now unsure about the economic landscape in the future, and at the same time, they see that, building costs are increasing, they might walk away from a lot of these projects that they had committed with, the likes of Wingstop, Kava, and so on. And then that would curtail the expansion plans of these companies. So these companies, they trade at high PE because they were growing very quickly. So as there are a few, factors that slow them down, the market might look at this and say, oh, this is no longer a high growth company and the PE needs to re-rate downwards. So Kava has already moved quite a bit. Wingstop also. I don't know about the remaining two. I think EAT still has a bit of potential to move downwards. But again, do your own work. The whole point here is not for me to do the work and then hand you the right trades to put in your portfolio. So a very important segment. I think this is the last segment of the presentation. The question I was asking myself is, has net interest margin peaked? So just for people who are not familiar with this term net interest margin, it basically is the margin that banks are able to earn on loans. So basically banks, they will take depositors' money and then pay them, let's say 3%. And then they'll take that money and then give it as loans and collect, let's say 8% on these loans. The net interest rate margin would be 8 minus 3, which is 5%. However, this net interest margin, it fluctuates with the slope of the yield curve. So what I've got here is a term premium on a 5-year zero coupon bond. I would encourage you to read into this because I cannot explain everything in detail. Basically, the term premium is the extra premium that long-term investors demand on a long-term bond, right? So, for instance, if you have a 10-year bond and you have a 5-year bond and you have a bond that expires in, let's say, 3 months, they will all have differentials in the interest rates that they charge, right? And the reason behind it is because of this term premium. So this term premium varies depending on the interest rate cycle. And typically it goes down as the Fed is cutting rates. And you can see from, let's say, 2008 onwards, all the way to 2010, which is basically when the Fed was cutting rates like crazy, this term premium went negative, right? Actually, the way to read this is, yeah, so the term premium is on the y-axis on the left, and then the net interest margin is on the y-axis on the right, so over here, right? So we've got two scales here. So what we saw here was that the net interest margin was even negative for quite some time. And you would remember in this phase, the banks in Europe and the banks in the US were having a very difficult time. And they were literally finding it very difficult to generate net interest margin. And then as the Fed hiked, that caused, it was a great time for banking sector because now they have quite a healthy net interest margin. So the question I'm asking myself here is, if we go into a cycle where the Fed might start cutting because the economic growth is slowing down, that would imply that the term premium goes down. And with that, I think there is a potential for this net interest margin to go down. So you'll also see that this net interest margin index has been discontinued from 2020 onwards. So that was something that was measured by the US government, no longer being measured now. But you can still find it within, individual banks. If you go and look at their financial statements, you'll see a metric called net interest margin. And this is basically a collection of all the banks in the US and averaging it out. The reason of having this slide here was to show you the relationship between the two metrics. So moving on, the question is, are we going to see term premium going lower, which basically implies that net interest margin could have peaked from here? Because if that's the case, as a short in banks or regional banks or whatever financial institution that's getting involved in lending, you have a significant vantage point here. This is going to be a short for quite some time. And again, not yet in the financial media, no one's talking about it. So you're literally getting the front row seats again, right? This chart over here illustrates the relationship between term premium and the stock price of the KBW, which is basically the banking index, right? As you can see, as the term premium, how do you read this? Yeah, I think the way to read it is when term premium is positive, then you typically see stock returns to the tune of 15% in the banking sector. When term premiums start falling, then you see significantly lower performances within the banking index. So what I'm suggesting is we might be at the start of this trend if the Fed starts cutting. And there would be a confluence of factors again that would drive a lot of these bank stocks lower. Delinquency, reduced growth, and so on, right? So this is an area to start looking into. This is a similar housing short moment for you guys, just to give you a heads up. It's not the easiest of industry to research, but if you look into it, you'll be able to make sense of it. I think most of you guys are very number literate or inclined towards numeracy, so you should be able to do your own research. Use a little bit of Google and so on, and then try to figure it out on your own. Of course, you can always ask me questions in the Discord server. I'm always here to help. So I wanted to show you also what's happening to Capital One Financial. So this is the latest earnings report. Everything looks fine so far, right? Net interest margin, net interest income was flat quarter on quarter, but up 8% year over year. But that's the past, right? We care about the future. And if the future says that the net interest margin would be probably around 6 or even 5.5 or even lower, and it's projected to get even lower in the future, that's going to spell trouble for this stock. So Capital One is a great company in terms of the data that they provide. They give data by different segments, being credit card, domestic, US, it's credit card, domestic card, consumer banking, and then they've got commercial banking as well, which I haven't got here. So very interesting to note that the non-interest expense is going up quite significantly. So that will have to do with salaries and all the admin costs, cost of acquisition of clients and so on. At the same time, we're also seeing a worse off in the net charge-off rate. So net charge-off rate basically means the loans that have been written off, right? So year over year, from 2023 to 2024 Q4, it's gone from 5.33 to 6.02. So that's a deterioration, right? Don't just look at the provision for credit losses as an indication of whether it's going bad or not. Look at the actual numbers here too, because these numbers are a bit subjective. It's up to the company to decide them. It's based on their own future assumptions of delinquencies and so on. The same kind of trend being seen on the domestic card, which is basically a credit card itself, just branded differently. They also, because it's domestic, it's their own. They can also give the 30 plus day delinquency rate, which is kind of stable if you look at it. But the net charge-off rate again sees a significant deterioration here. So use this in conjunction with all these industry metrics that we were looking at. I think it's quite clear to see that the US consumer might be a little bit stressed and that delinquency might flare up from here, right? And then if we look at consumer banking, very similar trend. So these consumer banking would basically be personal loans, auto loans, and so on. They've been originating a lot of auto loans, so that's interesting to see. Another area where the non-interest expense is up quite significantly, and at the same time, what we see is an increase in the net charge-off rates, right? So I'm just giving you a snippet. I'm not going to work the whole idea for you. That's one company. There's quite a few I've mentioned. There's a lot that you would see also that trades in the market. Do your own work and try to put all of this together and, figure out what's the right trade to put in your portfolio. Finally, some potential long trades. Remember, we cannot just be short in the portfolio. we need to have a reasonable bias, whether it's net short or net long or even neutral. We cannot just be 100% short, 100% long. So the longs are basically for a scenario where the market bottoms and then we get a recovery from there. So there's still a lot of good things happening within the energy space. So natural gas, for instance, it's being looked at as a solution for a lot of the power requirements for data centers. So you could look at midstream companies like EPD, ET. These are basically companies that transport the liquid natural gas. They would compress it, store it, and so on. And also you've got AR, which is basically a producer of natural gas. So within that space, there are many companies. I've just picked a few. You can always do your work and figure out what could be better longs. And then I think uranium could also take center stage here. So we've got Cameco, which is a big producer of uranium. The problem here is it's got a lot of its mines in Canada. And with this whole battle between US and Canada with tariffs, who knows how this is going to end up. So just be a bit careful there. I think the stock has sold off quite a bit. And if we see resurgence in the uranium prices, I think this could re-rate quite significantly. Then in terms of high quality tech, there are a number of companies out there. We've looked at GitLab, DigitalOcean, BlackBerry. Although BlackBerry is a low and mid cap company, just be careful of this. The market is not currently looking at mid cap that favorably. So you either could say, okay, I'm going to wait a little bit before putting my BlackBerry long, or you could say, I'm not going to put BlackBerry long at all. Or you can wait for it to sell off even further and then put it at a lower price. Once you're equipped with the thesis, the world opens up for you. You've got as many choices as you want. Then we've also got, we've had Broadcom, so AVGO. They've reported earnings and confirmed that the hyperscalers are committed to this infrastructure build for AI. So I think that's going to keep continuing. And we've looked at a few companies in the past in Lumentum Holdings, Light, Coherence, COHR, Celestica, CLS, and then Astera Labs. I don't think we've looked at this in the Discord server, but that's a name that you can research on your own. And I think if we have a correction here, if we have the end of the correction here, these companies could re-rate upwards quite significantly. And then finally, we've seen that the market or capital is seeking the security of large caps. And if we do large caps, defensive, companies that have mission critical products, I think that's a good place for us to find some long ideas too. We've got one company, ICUI, which manufactures IV fluids. I think Hans was the one who worked on the thesis. This is quite an interesting situation, especially as one of the hurricanes had damaged a significant IV fluid factory in the US. So IV fluids is not something that's going out of fashion, right? It's mission critical. And this company doesn't just manufacture IV fluids. It's got a lot of other things going. So do your research, look at Hans' thesis. I think it's highly useful just to get all the moving parts together. And then I've got one more company here. It's called Embecta Corp. Basically what this company does, it's a low and mid cap, I think around 1 billion market cap. It's a manufacturer of pen needles, syringes, a lot of products designed for diabetics and people who suffer from allergies. So again, this is mission critical, and it's a company that I've researched in the past. I think it's well worth looking into it. It is boring types of companies, low PE, that have a few things happening from a transformational strategic perspective. And the market is not currently looking at this a lot. So do your research, figure out whether there's room for growth in these types of companies. Okay, that's about it from me. If you have any questions, feel free to get involved. There's a slide I wanted to show you, but I don't know where it's gone. Okay, not sure where it is. Okay, so feel free to open your mics and ask any questions.
Oshan, just
Yeah.
for ICUI, just wanted some advice. Really, I've done earnings review, and two things. Like one, it did say we have a lot of exposure to Mexico.
Right.
So a lot of manufacturing is done in Mexico. I don't know how that is going to play out.
Right.
But another thing is like we started a new product and in 2024. It's quite innovative. It's like a software system where we manage all their infusions so that the nurses don't have to constantly go to patients and manage it in an ICU setting.
Okay.
So it can have big savings in terms of human resource, and that's
Yeah.
something I've never seen before.
Yeah. Not just savings, but also it helps with monitoring, right? If a patient dies, you have,
Absolutely.
fully
And even like,
integrity, full integral data of what was administered to him at what rate, and yeah.
and also the intensivists can manage. So all this is very
Yeah.
positive.
Yeah.
They've not. It looks like they'll sell it as a software with like a sort of membership kind of thing.
Okay.
Current,
Yeah.
but they've not given much detail. So I'm a bit
Yeah. I
on the
mean,
fence just because of Mexico thing.
yeah. It really depends here at what stage they are in commercializing this software offering. The great thing with these companies is these industries are not that big, right? There are not many competitors. So they already know the whole network. And for them to push their products through is not very difficult, especially if there's a, clear-cut value addition, value proposition from these products.
So
So
they've done a few trial. I think they've got really good feedback from the staff in
yeah,
the hospital.
yeah.
So I'm
I mean,
assuming they'll get that far.
I would expect that because eventually the hospitals are leaving innovation in their hands, right? Because hospitals cannot go and innovate in these technologies. It would have to be someone outside. And then someone who has a garage, who's sitting in a garage, is not going to be able to come up with these products, even if they are. They don't have the wide network to commercialize it as quickly as a company like ICUI would be able to, right?
Yes.
So that's a very good point that you've raised. I'll look into it myself.
I've done the earnings
Yeah,
summary.
I haven't yet gotten through it. I think it's something for me to dig into.
All right.
Any questions, anyone else?
Maybe Roshan, I have one question.
Yeah, go for it.
Yeah. So, when the market, like it's having like a broad sell-off right now, and then we are looking into long ideas. The long ideas might be like, like really convincing. So what kind of timeline we need to look into, like, when we are going long in these ideas, given that right now the broader market is coming down? Like, how do you deal with this?
So there are a few things you could do, right? The timeline is always catalyst driven, which would be around earnings and so on. But there are a few things you could do. As the market is selling off, just do your research, firm up on the thesis, decide whether it's a long or not, right? Once you've done that, then start playing with your option structures and figure out, what would be a good play. In this, of course, at this moment, you want to have more duration for your longs because you need to give it time to work out, right? So typically you would want to have endless duration, which would not be possible. But you will have to settle for, you're not going to you're not going to buy a call option that expires in 3 weeks. Yeah. You're going to buy something that's maybe 1 month, 2 months out, and then, you use the current market environment to get it at a relatively lower cost. And then you set up your spread to reduce this spend even further. Because remember, if the stock is going down, it doesn't mean you're losing money, right? You could be making money with your spread, right? The only problem is the lower it goes, the less likely it looks to go back to your break-even point, right? So in this case, your priorities are as follows. You want to give it as much time as possible, but of course you cannot do 6 months, right? It will just take away from the whole ROI of the situation. You want to get your break-even price as low as possible. So you have a fighting chance, even if the stock goes down 5-10% more, right? And then you want to be able to, you need to be prepared. First and foremost, you need to be prepared. And then determine when is the right time to action on these ideas. The same thing that we do for shorts, where we look for fake rallies and all. You could just look for, let's take an example, your long GitLab, right? The stock was like close to 60 1 or 2 days after earnings. Then we had a sell-off in the market. It goes to 55 or whatever, right? So now the question is, do you have confidence in your thesis, or are you scared because the stock is at 54, 52, 51, right? Which one would it be? If you have confidence in your thesis, basically what you'll do is you'll say, okay, it's at 50. I'm going to start building a position. I'm going to make sure the break-even price is not too high. Maybe break-even price is 53, 54, whatever. And then if the stock goes to 48, you're still in the trade, right? You're not out of the money. But then if the market corrects and it goes back to 60, you already make 3 times your money easily, right? So the whole point is to never be scared of these market moves. Do not seek for validation in daily moves. The daily moves are just all over the place at the moment.
Okay, thank you.
Okay, and because you're trading spreads, that gives you a lot of flexibility in terms of how you want to structure the risk. And you have a high volatility environment now, which means both your calls and puts, both your calls and on the long and short end will both have high implied volatility, right? So you can put your trades accordingly, where you buy probably when the stock shows a bit of weakness, and then maybe in the morning the stock opens low, you buy your calls, and then towards the end of the market it shows a bit of weakness, then you set up your shorts. That difference in the spot price in itself would help a lot in terms of improving your ROI. So that's what I mean by you need to be a bit smart. You need to be one step ahead of the market. And how do you do this? This is always fundamentals. If you're equipped with fundamentals, you have a chance of being one step ahead of the market. And then you just basically take advantage of the price action today.
Thank you.
It's counterintuitive. It's against the grain, but that's why it's not easy to be successful in trading, right? Because a lot of the things you do have to be almost like counterintuitive. It's not how we are wired, right? We are wired to be afraid of losses, of, when you see red all over your screen, you're wired to be afraid of it, to panic. We're wired to be super happy when we see green all over the place. You have to unwind all of this and do the complete opposite. When things are just rallying, you have to be a bit skeptical too, especially when the fundamental picture is not aligning.